This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Big winner. Tech stocks helped lift the NASDAQ in May, recording its 7th straight monthly gain. But what might happen in the weeks and months ahead? Healthcare battleground. Lawmakers are back in their districts, and the debate over Medicaid expansion is playing out far from the Capitol. Rise of the machines. Well, not so fast. Why some say robots will not steal jobs and that they may, in fact, create them. Those stories and more tonight on Nightly Business Report for Wednesday, May 31st. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. The month of May is in the books, and what a month it was. Earnings results were upbeat, the global economy steadied, and volatility was subdued, for the most part, except for a big slide mid-month driven by political turbulence out of Washington. As investors looked for growth, they plowed money into the NASDAQ, which saw gains more than double that of the Dow and the S&P 500. But today, stocks closed lower, pressured by financials and energy shares. The Dow dropped 20 points to 21,008. The NASDAQ was off 4, and the S&P 500 fell 1. The decline in energy shares tracked the price of crude, which touched a 3-week low to settle below $50 a barrel. So tonight it's time for a new segment we're going to debut. It's called Investor's Edge. We'll help you see what the pros see by highlighting the information that they use so you can make investment decisions like the pros. Here to help us do that, we're joined by John Najarian, founder of the Najarian Family Office. Welcome, John.
Great to be with you, Sue. Thank you.
Now, this basically is a way for the long-term investor to see what the big guys on the street are doing and where they're moving their money, correct?
True, because what we do, Sue, is we follow institutional trading and hedge funds. And by that, I mean trades of usually $10 million or more, which is usually bigger than most of the rest of us are making trades.
We aspire to do that.
Exactly. And if you follow these guys, maybe you will, because a lot of the bets that they're making are basically bets based on what has the best upside potential from that particular point.
So you follow the money.
Yep, we're following the fast
form.
money.
You're following the fast money. So where is that money going at this juncture? Because May's in the books, and we're looking at the summer.
Well, and you just let in with crude oil is down for the month, and it had, I think, 3 weeks of declines within the month, breaking $50 a barrel. The crude oil stocks, the stocks that make money from crude oil being higher, were getting hit much harder than the commodity itself. So we think a lot of the fast money right now is betting on a rebound. I know Tom Lee has made a similar call, and it's a bit of an outlier, but that's where the really big institutional money, Sue, is going right now, is into big stocks like ExxonMobil, which I do not own, but into that group as well as the fracking stocks. Fracking stocks were down even harder than the big stocks this month, and they're betting on a rebound.
You say they're also looking at the steel sector, which is much smaller than energy. So your choices as an individual investor are somewhat more limited.
Yeah, and these two, I own both of these, U.S. Steel and AK Steel. U.S. Steel is symbol X, AK Steel is AKS, and both of these have been seeing some decent money flow after a big sell-off. I mean, they were betting on the infrastructure spending that President Trump talked about. It didn't happen. They came all the way back down to where they were before the election. And now people are betting maybe something happens in the second half of the year, and they want to get in for the last month of the second quarter.
So as we say, this is to give the investor an edge. But do you then follow those fund flows or that money flow? And how quickly do you usually change? I mean, because those are big money trades, but they tend to trade more often than the individual investor.
Exactly. And so what we do is we try to parse through, Sue, the very short-term trades, in other words, derivative trades, options that are out there just 2 and 3 weeks into the future. That's not a long-term trade. But the options that are out there in September and December, which we're seeing now in bigger and bigger numbers in both energy and steel stocks, those are the ones we're following. So I think you can, sort of follow the fast money without risking quite as much as they had to by coattailing on them.
All right, John, great to see you. Thanks so much for joining us.
Thank you, Sue.
John Najarian with us tonight. Well, a weak report on housing pressured the market today as well, and that's because prospective buyers are being hurt by a 1-2 punch: low inventory and rising prices. Pending home sales, which are homes that are under contract but not yet closed, fell for the second straight month in April during what should be the strong spring selling season. Diana Olick has more.
You can't buy a house if you can't find a house for sale. That's the problem plaguing the housing market this spring. The number of buyers signing contracts to buy in April fell 1.3%. Some were expecting a slight gain. These so-called pending home sales, which close in a few months, are now down over 3% compared to a year ago, according to the National Association of Realtors. The trouble is too little for sale, just as demand is growing. More listings came on the market in April, but supply is still down 9% from a year ago. Realtors say they do not expect the situation to improve much this summer, as home builders are still operating well below historical norms. The hotter months are unlikely to cool demand, which is why home prices continue to sizzle. For Nightly Business Report, I'm Diana Olick.
The Federal Reserve says the economy grew in April through late May, with most regions describing growth as moderate to modest. In the central bank's latest survey of economic conditions, the labor market is being characterized as tight, with companies citing worker shortages across a range of occupations. The Fed also said that wages are rising, but that inflation was little changed from its previous reports. President Trump has not yet made a final decision on whether to withdraw from an international pact aimed at slowing climate change. The president, who met with his EPA chief today, is expected to make a decision soon. But some reports say he's leaning towards withdrawing from the so-called Paris Accord. And that pressured shares of both solar stocks and also coal stocks. The solar industry says it expects to thrive no matter what the decision, but some coal companies are concerned that an exit could lead to a global backlash against that industry. Meantime, big business is urging the president to stick with that agreement. Those companies include Chevron, ExxonMobil, I should say, Walmart, Microsoft, Apple, and Nike, among others. As we mentioned earlier, oil prices today touched a 3-week low as rising Libyan production fueled concern that the OPEC-led output cuts are being undermined. But the dynamics in the oil industry could change. Venezuela, one of the largest oil producers, is in economic crisis, in large part because of the drop in prices of oil over the past couple of years. Jackie DeAngelis explains why the energy market is watching Venezuela so closely.
Venezuela's economy has been teetering on the brink of economic collapse, with widespread shortages of just about everything, including food and medicine. So lower oil prices could be catastrophic for the country. That's because Venezuela sits on more oil reserves than Saudi Arabia, roughly 300 billion barrels, and production is a little more than 2 million barrels a day, accounting for about 95% of the country's export revenues. Oil money is Maduro's lifeline. But with oil revenues down and unrest on the streets, the government has less money to invest in the upkeep of its oil fields and refineries, and less to invest in new technology and projects.
If the government doesn't get a handle on the turmoil, then we're simply going to see that they'll have an utter inability to produce almost any oil. And given that it's 95% of their export revenues, that's a horrible recipe for the country.
The situation is teetering, and analysts expect that it could worsen quickly. Some suspect a mass exodus of oil field servicers. That could cause production problems. Some models calling for scenarios where 1 million barrels per day are lost rapidly. Meantime, what happens in Venezuela isn't contained there. These events could also impact the overall oil market. A loss of 1 million or possibly 2 million barrels a day could be a black swan event that spikes prices globally, just as they settled around 50.
We've seen that crude oil has now come back into a bit of a trading range, about $45 on the bottom, $52 on the top. Absent some sort of catalyst, I would expect it to stay in that range through the end of the summer.
A drop in Venezuela's production plus OPEC's recent cuts would be enough to burn through some of the global glut. The worst-case scenario may not pan out, and if it does, it may not be tomorrow, but it's definitely rising on the radar. At the same time, if a regime change occurred, many anticipate reinvestment in the oil industry to ramp quickly again. For Nightly Business Report, I'm Jackie DeAngelis.
Still ahead, unclear prognosis, why a cab driver in Little Rock is watching Washington closely. New York City is the latest metropolitan area to cut ties with Wells Fargo. The mayor and the comptroller say that they will vote to bar agencies from renewing or expanding contracts with the bank. They will also support the move to end Wells Fargo's role in managing bond sales. New York City is one of the largest bond issuers in the country. The decision is in response to the bank's fake account scandal. Ohio's Attorney General sued 5 drug companies today. The office is accusing them of misrepresenting the risks of prescription opioid painkillers. The companies are also being accused of committing Medicaid fraud. This is the second suit of its kind brought by a state after Mississippi. The 5 companies being sued are units of Purdue Pharma, Johnson & Johnson, Endo Health Solutions, Teva Pharmaceuticals, and Allergan. In response, Purdue said it shares the Attorney General's concerns about the opioid crisis. Johnson & Johnson called those allegations unfounded. The maker of EpiPens may have overcharged the government more than $1 billion for EpiPens. The Department of Health and Human Services said that between 2006 and 2016, the U.S. government may have overpaid Mylan. That dollar amount is nearly 3 times a proposed settlement that the company announced in October. Mylan says the company continues to work with the government to finalize that settlement. North Carolina's largest health insurer may increase rates by more than 20% for the second year in a row. The hike is tied to uncertainty over subsidies for low-income enrollees.
This is an urgent situation, and we simply need to know what the rules of the game are going to be for 2018 in order to hit affordability as well as stability.
If those cost-sharing subsidies are funded next year, Blue Cross of North Carolina says it will still need to raise rates, but only about 8.5%, not 20%. Lawmakers are back in their districts this week, but as Senate Republicans work on their version of the health care bill, there's one issue that looms large: what will happen to the expanded Medicaid program for low-income Americans? And as Kayla Tausche reports, that debate is playing out in Little Rock, Arkansas.
George Coleman drives a cab for a living, but struggled to pay for health care as his asthma worsened and the cost of his medication got higher.
One of the inhalers can range from anywhere from $400 to $600 a month.
Coleman is one of 330,000 Arkansans whose incomes made them newly eligible under the state's expanded Medicaid program.
I truly have been born to believe that you work for what you get. And you whatever it is that I get, I want to earn it. But this is something that is beyond probably my means.
Governor Asa Hutchinson says the popularity has made the program too costly to maintain.
We estimated 250,000 that would go on the expansion, and that soared to 330,000.
This month, the state moved to pare it back, adjusting the qualifying income levels to reduce enrollment by 60,000 people.
We're curtailing those numbers as a cost-saving measure. And it's not an easy thing to do. I think we've laid the groundwork here for reform in Arkansas that will be sustainable over the long term under the status quo.
For Arkansas hospitals, the status quo works. Here at the University of Arkansas for Medical Sciences, the number of uninsured patients fell 80%. The clinic turned a profit and hired more than 1,000 people. What's more, the state as a whole saw no hospital closures. But with looming cuts to these healthcare programs, Dr. Dan Ron says that stability and growth is at risk.
We're being very careful about long-term capital investments. No community can experience economic development in the future if it does not have sufficient healthcare resources in that community.
Medicaid expansion is dividing Senate Republicans as they draft a new bill, pitting lawmakers from states like Arkansas that expanded coverage against those who didn't. President Trump tweeting today, Republican senators, whom he called good people, should pass their proposal quickly. Arkansas is trying to make its program last either way. For Nightly Business Report, I'm Kayla Tausche, Little Rock, Arkansas.
Michael Kors is tightening the purse strings as sales fall, and that's where we begin tonight's market focus. The handbag retailer missed same-store expectations, saying its product offerings didn't appeal enough to consumers. The company posted a loss and saw overall revenue fall, but those results still beat expectations. Michael Kors plans to shutter as many as 125 stores over the next 2 years as it focuses on improving profitability. Shares fell more than 8% to $33.18. Shares of molecular diagnostics company Exact Sciences surged after news last night that United Health Group will cover the company's colon cancer screening kit. United Healthcare said patients between the ages of 50 and 75 will be allowed to use the test once every 3 years. Exact Sciences shares popped 11% to $36.47. After the bell, cybersecurity company Palo Alto Networks reported revenue that grew thanks to more customers. Those results came in ahead of expectations. The company also saw profit come in above estimates, and it gave strong guidance for the quarter. Shares initially surged after hours and also ended the regular session up 1% to $118.59. The Federal Aviation Administration accused United Airlines of flying a plane it says wasn't airworthy. The FAA is proposing to fine United nearly $500,000 for failing to inspect a newly installed fuel pump switch back in 2014, and then allowing the plane to make 23 flights before inspection. United says it's working closely with the FAA. United shares were up just a fraction to $79.67. Coming up, think a robot's going to take your job? Well, you might want to think again. Whirlpool is renewing allegations that its South Korean rivals illegally undercut prices on washing machines. The company said it plans to make a filing with the International Trade Commission against Samsung and LG Electronics. The issue has been simmering for a while. If the Trade Commission decides in Whirlpool's favor, it could recommend that the White House step in and put tariffs on the rivals' products. JetBlue may soon start to scan your face. The airline is testing facial recognition software in an effort to streamline the boarding process. Passengers will step up to a camera, and the kiosk will compare the facial scan to the passport photos in the U.S. Customs database. The system will start next month for flights from Boston to Aruba. And innovations in technology is all the talk now at the annual invitation-only Code Conference. It was created to bring together some of the biggest names in business to discuss the future impact of digital technologies. Julia Borston talked with the head of Netflix about his business and where the industry is headed.
Netflix has grown to over 100 million subscribers around the world, but it faces more competition than ever as Amazon and Hulu invest in original content and YouTube and others launch streaming services. Of all these rivals, Reed Hastings tells me he's scared of Amazon.
They're so scary. I mean, everything Amazon does is just so amazing. I mean, how are they doing so many different business areas so well? It's like they're trying to repeal the basic laws of business of limited capability. So we're continuing to watch them and be impressed with them. And they're helping to grow the industry because they're investing in the content.
While Hastings says he's scared of Amazon, he also tells us he's not going to try to out-Amazon and won't buy sports rights just because Amazon is investing in NFL games. There are a number of media giants here talking about how they'll compete and reach consumers in the crowded digital age, including the editor of the New York Times and the CEO of Time Warner. But Hastings tells us he's focused on growing Netflix's library and continuing its global expansion.
We've done awfully well in Latin America and in Europe and, of course, in North America. So we've learned some things, but we have a lot of room to grow in Asia and a lot to figure out still.
What about China? You're licensing to China, but are you still trying to launch there, or is that off the table?
I think that's off the table for the next couple of years.
And Hastings says Netflix's success is not at the expense of the traditional television business.
Very few people have cut the cord. We're about 50 million in the U.S., and we've seen maybe 2 or 3 million of 50 cut the cord. So don't think of it as a big overlap that we're driving cord cutting. That's probably mostly from pricing. And in general, if you look at cord cutting, it's like 2 or 3% per year, like broadcast ratings over the last 30 years. And so it'll have, I think, a very long, slow slow secular decline, no big calamity, and then they'll adjust the economics.
Whether it's the New York Times embracing Twitter or Netflix bringing its movies to theaters, old and new media giants are here in Southern California debating the best way to connect with billions of consumers. For Nightly Business Report, I'm Julia Borston in Rancho Palos Verdes, California.
And speaking at the Code Conference, venture capitalist Mark Andreessen says robots are not stealing jobs. That, of course, is contrary to what some are predicting will happen more and more in the labor market. He used concerns over self-driving vehicles as an example, arguing that this new industry will create many sub-industries and also, therefore, jobs.
It's a recurring panic. This happens every 25, 50 years. People get all amped up about machines are going to take all the jobs, and it never happens. The jobs that were created by the automobile on the second, third, and fourth order effects were 100x, 1,000x the number of jobs that blacksmiths had. And so this goes to kind of the fundamental kind of flaw in the logic, though they call it the lump of labor fallacy, which is technological change causes productivity growth. Productivity growth lets us produce more of what we can already make with less resources, and then lets us create that's what frees up the spending power to let us create lots of new things, create lots of new demand, and that's what creates new industries, and that's what creates new jobs. And then 100 years later, we look back on it and we're like, I can't believe anybody was ever a blacksmith.
Well, we have two guests now with opposing views on whether or not robots are stealing jobs or will steal them in the future. Amol Sarva is professor at Columbia University. He says robots are not stealing jobs. Wendell Wallach believes that they are and that it could get much worse in the next few decades. He's a scholar with Yale University's Interdisciplinary Center for Bioethics. Welcome to both of you, gentlemen. Nice to have you here. Wendell, I'm going to start with you because we kind of set this segment up with that comment from Mr. Andreessen. You obviously would not agree with what he says, but it's an interesting theory, is it not?
It is, but it's a backwardly looking theory, and it really doesn't look at the kinds of technologies that are coming online now. I would argue, actually, that automation is already putting downward pressure on wage growth and job growth. We see that. Technology, yes, contributes to productivity, but it's a slow, anemic contribution, and real wages for goods-producing workers have been flat for almost 50 years now.
Amol, what about that? There's no doubt that we're seeing innovations in technology, the 3D printers that are now creating all sorts of different things that humans used to have to work on. Why do you argue that robots are not going to take jobs?
If you listen to Mark when he's talking about the impact of the last 100 years, it is a story of change. I mean, none of us tries to be a train engineer or a blacksmith anymore. There's been massive change, and actually millions and millions of jobs have been created driving those cars that got invented, or airplanes, or mechanics, or designers, or builders for all those sorts of things. And we're in the midst of inventing all these platforms now. Those are the millions of jobs of the future.
You know, Wendell, is it as simple as certain industries may be more vulnerable than others? To Amel's point, new technologies create sub-industries that create jobs. But there are other industries where that is not happening.
Exactly. I mean, consider now that you have 3.5 million truck drivers in the United States. Self-driving trucks are going to appear on U.S. highways long before self-driving taxis appear in U.S. cities. So what are those truckers going to do when they lose their jobs to trucks that have been tooled to be self-driving? So I think sometimes we miss the point that the jobs that are being created are not the same as the jobs that are being lost, and you can't always move the same people in the workforce from one segment to another.
You know, Amol, to that very issue, we've talked a lot about the fact that if indeed robots do start to displace, not necessarily replace, but displace some workers, one of the issues is the lack of retraining for those new sub-industry jobs that may be created.
It's a point that's often made, and I think there's a point that's also often overlooked exactly on this, which is we don't have enough people. We don't have enough people in America to keep on growing and doing all the great things we did for the last 100 years in this country. If you look at 2070, where we want to be 50 years in the future compared to 1970, let's say, about 50 years ago, for our country to continue to expand and grow and make lives better so our children are living better, we'll need 2 to 3 times as many people in the labor force as we have now. But we're a country that's actually shrinking its labor force in the long run due to aging. The same technology that's been making infant mortality disappear and extending people's lives is taking people, relatively speaking, proportionately out of the workforce. We have relatively fewer workers in 2050 or 2070 than we have older people that need to be supported and young people that are alive. And technology is really the only other thing we can turn to try to boost our productivity and make more people effective to grow just this economy, all these things we need to do. And yes, displacement. I know displacement is going to be painful.
Very interesting point. Wendell, what do you think about that? We don't have enough people at this point.
Well, I think that's not quite true. I think there's a large segment of the workforce that does not have jobs right now. That's projecting that we're going to stay on the same course that we were in the past. But the important thing to note, and let's be clear from the outset, both sides cherry-pick their statistics here, but an important thing to note is there's a decoupling between productivity growth and wage and job growth. So productivity growth continues where the other two have stayed relatively flat. So that's an important thing to keep in mind when we're talking about the creation of new jobs, particularly when we're going to see the disappearance of jobs from technicians that read x-rays, from paralegals that do searches on who owns various properties.
Gentlemen, thank you so much. We appreciate it. Amal Sarva with Columbia University, Wendell Wallach with Yale University.
Thank you.
And that does it for Nightly Business Report. I'm Sue Herrera. Thanks for watching. We'll see you tomorrow.